let's talk now about the transition to Antipodes, where the idea came from, and then maybe you can just kick things off by telling listeners who aren't familiar what the business is that you started, what you do, and where it is today.
Sure. So Antipodes Partners, we describe our philosophy as pragmatic value, and pragmatic means it's an awareness around when businesses become cheap, what's leading that? Is it because people are concerned about the business cycle, or are they concerned about something much longer term that may be disrupting structural changes that may be disrupting the business? Because what we found, from value investing, is that sometimes people get lazy and they simply start believing that mean reversion works. I buy something. I buy this company when it gets to this PE, and I sell it when it gets back to this PE because it's getting bailed out by the cycle. And then one day that doesn't happen. One day that stopped happening with newspapers. One day that stopped happening with traditional broadcast TV companies. And it's because the cycle, the structural story is overriding. The long-term structural decline starts to override the business cycle. So pragmatic value, we're trying to avoid the value traps, but it's still an awareness around value. Ultimately, we're looking to buy great businesses when they become cheap. So we will be having some sort of argument with the market. The market will be saying, "Oh, this business is broken," or these regulatory changes are going to make it much harder for this company to make money. And it's sort of in the cool light of day trying to assess whether that's right. Whether that's rational or irrational extrapolation. How is that different, or why, the motivation for doing this at Antipodes? Look, I thought we could, at a stock level, I could execute that quite well where I was. I thought at a portfolio level, I needed more tools, more of a toolkit. So greater sophistication around some of the quant macro, measuring, using, doing more factor analysis to identify, how your portfolio, how it's characterized. You might think you've got a whole lot of cheap growth stocks or cheap quality stocks, which is really what we're looking for at Antipodes. But what if... and your factor scores may tell you that that's the case, but what if they're not behaving that way? Right? How long do we have to wait for them to behave that way, right? So in a market that, in the past 12 months, arguably we're living through a period in markets that's rarely ever been more sensitive to growth. Now, what do I mean by that? What I mean is, if you were to do if you create an index of companies that are high growth and see how their share prices are, how the market's behaving relative to that index, when the growth stocks are going up, the whole market's going up. Like the market's correlation to growth stocks is very, very high. That's, so if your growth stocks aren't growth sensitive, you may not participate in that, that bull market.
And are you saying that this correlation is very high now, or has it always been the case that...
No, it changes all the time. I mean, there's times when markets are very pro-cyclical, and it's, the cyclicals lead the market. And when the cyclicals are having a good day, the market's having a good day. And there's times when it's very bond proxy. It's utilities and when those stocks are having, or those sectors are having a good day, the market's having a good day. So it's not just, I suppose quant for us is three-dimensional, and it has two roles. So I'll start with the roles.
Yep.
We think quant helps us track the anomalies, and it helps us to know where we should focus the fundamental research effort. It's complementary to our experience.
Yep.
So it doesn't dictate. Just because something looks cheap, we may say, well, actually that's a value trap, or it's contextual understanding of where the interesting parts in the market may be. So where could we find, what are the quant tools or screening tools telling us where is there cheap quality growth stocks today? that type of screening, actively targeting certain factors to identify opportunities as a part of the fundamental research process. So identification.
Yep.
The second role is risk management. So, and I'll start off describing that by just, this three-dimensional view of quant. So quant will tell you what a company is, i.e. backward looking.
Yep.
In terms of, okay, this company's in the top decile of quality or bottom decile of growth, but has a great balance sheet. So it's, third decile of resilience. Mm-hmm. So you can have a whole lot of descriptors. The second dimension is, forget about all those descriptors. How does the stock actually behave? Does it have a beta? What style does it have a beta to?
Mm-hmm.
And then the third, or what macro, is it sensitivity to long yields or US dollar? So sensitivities to style and macro factors. How does it actually behave?
Mm-hmm.
Now that will change, but it's very important, I think, to have that understanding. And then thirdly, what am I paying?
Mm.
So most value investors just think about the value factor, whereas we think the value factor should be applied to every fundamental factor. If you've got a quality company,
mm-hmm.
what am I paying? If I've got a growth stock, what am I paying?
Mm-hmm.
So it's not a standalone. We don't see it as a standalone factor. On its own, it tells you nothing. Right? Multiple, higher growth, higher profitability. Companies with higher growth and profitability should trade higher multiples. So on its own, it really doesn't tell you a lot. It may tell you what, at a point in time, what the market looks like from a distribution of multiples. So PE dispersion. I think that's interesting. By the way, that's very high today. So, within regions and within sectors, it's quite high. So the averages, when you look at an average, you're not seeing a lot of information at the moment because there's broad distribution around the average.